Hey, it's Ryan from the Option Income Advisor, and today's trade analysis focuses on Disney. So this is a stock that it's been kind of polarizing over the last couple years. And I think the best way to explain it is through the chart, but I do think this is probably one of my top picks for 2022. And I'll explain why, valuation, kind of where it's going, how the market's viewing it. But I think it's a great play for 2022. Especially after the sell-off it recently had. So let's take a look at the chart. So I pulled this one back all the way to, so this was basically the start of the pandemic because I wanted to see, okay, where did this stock trade at? I knew it was in the, kind of 140 range roughly. And you can see, prior to, basically just prior to COVID, it was trading at $140 a share. So that was right here. Then the sell-off, obviously through COVID, priced in worst case scenario, clearly theme parks shut down. So this company had, something that a lot of companies didn't have, which was it had a segment of their business that was drastically affected by the pandemic. And then they had a part of their business that did amazing during the pandemic. And so that was kind of this move here, where I think people realize, like, okay, you see what's happening with Netflix. Netflix, bounced back quite a bit. There's this Disney Plus thing that they're launching. I mean, Disney did in 2 years what it took Netflix roughly 8 years to do, right? So between Disney Plus, Hulu, and ESPN Plus over the last 2 years, they've built up about 170 million subscribers. So compare that to Netflix, which has roughly 209 million subscribers. They've done that in the span of 2 years. So that's what the pandemic did for a lot of these businesses, is it pulled forward the adoption of a technology or a service, right? And that's what happened with Disney Plus. And so this was the tale of two companies, right? You had a big piece of their business that was doing awesome. You had a big piece of their business that was basically doing nothing. And so right around here is when I think the market realized, and we were feeling good coming out of the pandemic, that, we were getting close to vaccination, all that stuff. Then it really started focusing on Disney Plus growth, which was still growing significantly, right? So then you had this huge run up basically into March of this year. And that's when most tech companies kind of peaked, and it correlated with interest rates. Remember, we had an interest rate scare kind of in March where most of the tech companies came down, which is what you saw here. And then we had Disney bounce around, and I was loving this consolidation period we were having, kind of between 170 and 185. And I think the market was kind of just trying to figure out, okay, when is the theme park business going to come back? And, what can we expect earnings wise? We've got this nice stable Disney Plus business that's still growing. And so, we traded in this range. But then fast forward to basically a few weeks ago when they reported earnings. Okay, so the dynamic that's happening now, and it's almost like we went from glass half full with Disney to now we're completely glass half empty. So what's happening now is with the market where it's at and valuations, a lot of these businesses that had, I think, high expectations for growth are just getting absolutely pummeled for slowing growth. And if you think about it, it should be expected that coming out of a pandemic, especially a technology-related business, that you're going to see some slowing growth. So it's really kind of focusing on where do we go from here? How stable is that growth? That type of mentality. And that's not what we're seeing right now. Right now, you're getting just destroyed in the market for essentially missing expectations on growth. And so that's what happened when they reported. They reported slower growth in Disney Plus. I think they were looking for 125 million subscribers or something. They're only up to 120 or something like that on Disney Plus alone. And so market didn't like it, sent the stock, kind of in a tailwind from there, which kind of broke out of this, unfortunately, that range. So now it's kind of like, okay, where do we go from here? And now we've seen additional pressure. So this is why I said that, it's almost like the glass is half empty now with Disney, which I think is the completely wrong mindset. Because if you think about the businesses that they're in, what more would you want going into? It's like the best of both worlds. Going into 2022, knowing that we're probably going to have this reopening. I think what this new COVID variant has shown, and Biden just came out yesterday, and a lot of these governments around the world, lockdown is not an option at this point, right? There's enough antiviral and vaccine and all this other stuff that they know that lockdown is just a death nail, and so they're definitely coming out and saying no lockdown. So what more would you want going into 2022 than to have exposure to reopening, which I think is going to be a massive, massive shift in rotation, probably coming in the next 3 to 6 months. So I have exposure to that through these theme parks, which, by the way, in this last earnings report, the theme park growth was very good, to be expected because it was against comps essentially when the parks were closed down completely. But we're not going to have park shutdowns again, most likely, right? So I think it's only upside from here with the theme parks. So you've got the reopening exposure, which is amazing, but then you've got this base core business of what the other thing you would want during a slow growth or stagnant kind of period where we're trying to figure things out. You want stable cash flow. There's no better stable cash flow than the Disney Plus type business. And as far as just a media conglomerate, it gets no better than Disney, right? Just from a content perspective. I mean, they are the content king. So you have this stable growth, cash flow generating machine on top of a reopening play. I think that's the best combination and best of both worlds you can possibly have for a stock in 2022. So I would expect that, we're right around 147 right now. And so I would expect this 140 level to hold. I can't imagine this stock trading below where it was pre-pandemic, pre all this Disney Plus, before they added 170 million subscribers. I can't fathom, this stock going, below that. If it does, it's a screaming buy, but I think it's a phenomenal buy at this point right now too. So look, I think this is a great play for 2022, but let's just take a quick look, and I'll walk you through the valuation real fast. We'll take a quick look at the profile here. So, I mean, look, from a safety value perspective, it's kind of middle of the road. Safety, looks at balance sheet strength and operating history, but clearly we've had a tale of two companies here where, earnings have been volatile because of the theme park business and things like that. So we really have to look forward. But despite all that, it still has an average rating for safety, which is, I think, still impressive. And then from a valuation standpoint, same thing. We're at kind of not a trough because we've come out of the trough from an earnings perspective, but we're certainly at a low earnings level right now. And so we want to look forward a few years out to say where are earnings going to go and what's a reasonable valuation based on those future earnings, because that's really what we want to see, right? We want to see the combination of this awesome core, stable, cash flow generating core business with, the theme park business coming back online, which in itself generates a ton of cash. But we just need, more stability and certainty from that perspective. And so let's take a look, at valuation and some of the charts here. And so based on, and Disney, by the way, has always kind of traded at, this 5-year average is NA because it went negative for a few years, but it's always traded kind of in this 25 to 30, even 30 plus, PE from a PE perspective. And so I almost want to compare this to what we're looking at from like Netflix, for example, right? All right, so we've got a situation here where, you've got so this is based on forward. So this company reports in September. So their forward, or this next coming up fiscal year is September of 2022. So the forward earnings looks at the next year, which is September of 2023. And so they're looking to grow from about 4.25 per share right here. So this is for 2022. They're looking to grow that to 573 in 2023. So if we're looking at 23, we're looking to grow from this 425 up to about 573. Right, so we're going to see this earnings momentum continue to go. And then in 2024, which I think is the key year, where we're going to grow, they're expecting to go up to about 730 a share, right? So we're expecting to go up here. So we're almost going to be back to kind of peak earnings levels here very shortly. And so I would look at that number, at that kind of 730 number, and say, what's a reasonable multiple on that number going forward? And I would say somewhere in that 25 to 30 range. And that's not even banking on much multiple expansion. But I think once, again, the two businesses that they have, I think once those start clicking on all cylinders, I think you can definitely justify getting up to a higher multiple. Because you look at Netflix, for example. Again, Netflix has a little bit higher market cap than Disney does right now, but Disney has more content. They're closing in on them from a subscriber standpoint, and they have this other huge theme park business and cruise business and entertainment business that Netflix doesn't have, right? So from that perspective, I think you can look at these two companies and say, which would you rather be in, right? They both have exposure, obviously, to online media and the subscription service model there, which is extremely attractive, obviously, from an investment standpoint. But you have Netflix trading at over 50 times earnings. They've got about $34 billion of revenues. Disney's going to do over $90 billion of revenues next year, closing in on over $100 billion of revenues in 2024. So we're looking at a company that has 3 times the amount of revenue, closing in on a similar subscriber base, arguably has a lot more content than Netflix. So where would you rather be, right? This is a growth story with exposure to probably the two areas you want most. So again, that's I don't want to beat a dead horse here, but that's why I think this is a top pick for 2022. And I just believe that this company will be clicking on all cylinders soon. It's got great assets, great portfolio of content. Clearly has built an amazing subscription business, on top of everything. So if we look at, just from a valuation standpoint, if we look at 25 to say 30 times multiple on the 730 of earnings, and again, I'm going a little bit further out because I think this is a play where you're going to get some multiple expansion. Once you see stability in the theme park business, I think we're going to get a lot of stability there. So this works out to be about $182 a share, up to about $219 a share. Okay, right. So we're looking at 25 to 50% upside from here, and that would be a phenomenal return, over a 12-month period. So I think this is very reasonable expectations for where this stock could go over the next 6 to 12 months, right? And so this is the time to get in. Will it go a little bit lower? Maybe, but I really truly believe that 140 level probably will hold. Again, I just can't fathom it going down below 140, below where it was pre-pandemic, and given how this business has grown since then. And so this is what I'm looking at, and this is why I believe this is a very exciting story, I think, going forward. And from a sales perspective, I think it's even more exciting. You're right now you're at 2.9 times 2023 sales, and then if you look out to, again, that $100 billion of sales in 2024, you're looking at about 2.7 times sales. Compare that with Netflix. Netflix is trading almost at 9 times sales, right? So looking at these two valuation metrics, I think it makes a lot of sense, why this level should hold and why it would be, a good investment going forward. So what do you do from here? You can certainly buy the stock. I think this is a absolute buy from that perspective. If you already own it, certainly hold it. I would consider adding more at this level. If you want to do cash secured puts, obviously I'm always supportive of that. I think I would go out to this. I would go out to January. So the January monthlies does not include earnings, so I think it's an attractive time frame here. So you got 53 days left on this one. And again, because I believe, this in general hasn't been a very volatile stock, and so you don't have a very high implied volatility. A 30% volatility is actually pretty low. from an implied volatility standpoint. So you don't have huge premiums here, but I think you just have to target these levels, right? If you think it might trade down a little bit and you just want a little bit of extra margin of safety, I would say, hey, this 140 looks really good because I think that's a level that could hold. You're going to get 2.3% over 53 days. That gives you an average monthly yield of 1.3%. It gives you the ability to buy stock down at 140, so a little bit lower than the current prices. But you get paid to take that risk, and it still has a delta under 30. So I like that one. If you want to be more conservative, you could go down to the 135. It gets you almost 1%. But I really like this story going forward. I think it's a stock you want to be in. I think it's a stock that should do very well. Kind of regardless of I think the environment we're going into. I don't think we're going to have lockdowns. So I think the theme park business will continue to grow, and I think the market will start viewing the online subscription business as more of a glass half full situation than right now as a glass half empty situation, right? The slowing growth doesn't excite people, but you kind of got to think, well, what do you expect, right? You can't grow at pandemic level rates into perpetuity, right? It has to slow at some point, but I think what you have is a very good, stable, solid business. I know I'm not canceling my Disney Plus. I got 3 young kids. No way am I canceling Disney Plus. So I like the story, but that's the trade. And let me know if you have any questions. Take care.